afternoon, everyone. Sorry to be coming in between you and lunch. I'll keep it short. I've been given 15 minutes.
Oh, we have another session after you.
Oh, okay. Sure. Then still there's a lot more time. Without taking much time, I'll just move with this quote. Point is clearly that all of us know this, but we need to be invested in markets for the long term. Time is an important factor. Many of my previous speakers have talked about it, touched upon this. I just thought I'll just leave you with one important quote by Paul Samuelson, where investing per se is very different from gambling. All of us like to see the markets on a daily basis, the stocks moving up and down. It gives that adrenaline rush, but the fact remains that investing is for long term and it is far more boring. This is one of the most important slides that I would want to focus on. I wanted to cover a few basic concepts before I come to the style-based investing. One of this is that GDP, if we see, is not so volatile. On the right-hand side, you see the volatility. Clearly, GDP's volatility is not much. Corporate earnings volatility is little higher. The market volatility is clearly the highest. So GDP, broadly, if you talk about real, it moves, if the average has been 6, it has moved in the 4 to 8 range. Corporate earnings has grown in double digits and markets have grown higher than that, but with lot of volatility. That comes out of fear and greed. At different points, market sentiments change very quickly, and that provides opportunities. At the same time, that is the risk that we are looking at. So this is from Howard Marks, one important thesis. All of us keep saying that risk and return go together. Higher risk na higher return. So to that extent, you kind of say you take higher risk, you will get higher returns. That is true, partly true. That is what the upper chart shows. But the reality is the bottom chart. So if some of you who understand poker, simply if you take, if you get 2 aces in your hand, that is the best card that you can get. But that doesn't guarantee that you will win that hand. It's only probably 60% probability that you will still win that hand. There is still a 40% chance that you will lose that hand. Same way, you take higher risk, it doesn't necessarily mean that you will get a very higher return. The range of return is quite, there is a normal distribution where you could have negative returns as well, or you can have very high returns as well, and the average is higher return. So you need to understand that if you try it again and again, maybe through the longer period, you take higher risk, you will get higher return. But in one instance, now and then rumba high risk high return vandrona, it is not true. That is where many of us feel cheated, that I took high risk, but it turned out to be wrong, so this is not fit for me. The fact remains that if you take higher risk, still the outcome can be very different because it's a probability. There are multiple factors in the short term which can impact the outcomes. Again, this is a study done by Morningstar where the mutual fund returns are in blue bars and the investors' returns are in the orange bar. Clearly, you can see that orange bar returns the blue bars oda romba korachirukku. That's the investor behavior gap. Wrong time, Sandeep Tandon sir did talk about at the peak everyone is confident and at the bottom everyone is pessimistic. Same way, at the peak if someone gets very aggressive and invests, and at the bottom they redeem, you obviously see the behavior gap, and because of which the returns actually tend to be lower than the actual returns that the fund or the investment could have yielded. Now, in this context, coming to style-based investing, all of us know, there are 2 major styles which are talked about, which is growth style and value style. Here, since we don't have a pure growth index, we are using quality and growth interchangeably because many of these growth companies are also quality, and to that extent, we are kind of using that interchangeably. we could have momentum-based investing. Simply put, the stock price goes up and you keep expecting it to go up. The trend is your friend. So that is momentum investing. Or you could have large cap investing, small cap investing, mid cap investing, and so on. And the final one is, I mean, if growth is at one extreme, value is at one extreme, the middle is the gray shades. I mean, I belong to that part where growth at reasonable investing, which I'll talk about in detail. But what we've seen is that whichever style, whether it is momentum, quality, which is representing growth, or value, all of them have outperformed the NSE 200 here we've taken as the benchmark. The benchmark over a longer period of time, clearly. So point being that whether you're a value investor, whether you're a growth investor, momentum investor, as long as you stick to that style through the cycle, you can still create alpha. So now coming to how is the style defined? Investor, distributor, or even for that matter, the fund manager's investing style defined. What are the factors which define that style? One of the research papers we pulled out talks about some of the factors. It could be biological. I mean, if you are identical twins, have the same genes, then you're likely to have the same style of investing. If you're fraternal twins where only 50% of the genes are matching, there is a possibility that your styles might actually differ or have lower correlation. Same way, time horizon. I mean, if you have very long term, probably you will say I'm a growth investor, or if you're looking at little shorter term, you would actually look at yourself as a value investor. Again, behavioral biases, two fathers of investing. Benjamin Graham had a very a tough beginning, and he was generally in the family considered as a person to bargain for any purchases. So he was always a bargain hunter, value seeker, and that is the style that clearly came along in his future style. While on the other hand, T. Rowe Price was from a very wealthy background, and to that extent, he became the father of growth investing. So your earlier life experiences also have an impact. And the other one is clearly in what cycle you are. I mean, if you were, you entered the career somewhere around 2008, around the GFC crisis, probably your outlook would be a lot tougher. But if you were in 2003-4, when the markets had just started to boom, the approach would be different. So in what part of the cycle you entered the job market also has a factor in what is your style. Now, just on that point, I mean, why this is important is that each individual has a style. If onion padathila mari 1 minute ambi, 1 minute the remo, and the mari style change panna mudiyadhu yaaralayum. If you are more of a growth style, you will continue to be growth style. If you are a value style, you will continue to be value style throughout. So that's where it's important to understand yourself as to in which bucket do you fall. And then now coming to my style, these are some of the learnings from my experiences over the last close to 2 decades. In my approach, I've focused a lot more on growth and or cash flows. Idea is either the company should have very high growth, or in the event that it doesn't have very high growth, at least it should give me cash flows. If either of these two are missing, then probably that's not an area I would want to venture out. Again, when we look at GARP, what it means is, if it is a high growth company ready to pay a high valuation, high PE, high price to book, but if it is a low growth company, the valuation metrics have to be lower. So it doesn't mean that I will not look at low valuations or low growth businesses. It's just that it should be at a commensurate value. And similarly, even in some cases, we could have turnaround companies where the turnaround is not fully reflected in the stock prices. Then again, long-term, think long-term. I did start with that. Clearly you have to think long-term. Like I said, in the long-term, whichever style you invest in, it clearly works out. But the markets go through cycles. 2-3 years you have growth cycle, 2-3 years you have value cycle, and so on. So for your thesis to play out, you will have to have a longer horizon. So that's where the longer-term approach is required. And Vijay Kedia sir did talk about this. I mean, capital allocation, what is the management up to in the future is something that I constantly need to keep evaluating to understand whether to stay invested or reduce my exposure. And in a growth, the GARP approach, idea is to look at historical numbers. If historically it has grown at 10-15%, it's better to assume that rather than say, painting a rosy picture and saying that now in the future it will grow at 30%. Generally it doesn't happen. Exceptions may be there, but generally it doesn't happen. So to that extent, reasonable assumptions is one of the key ingredients for GARP. And the learnings clearly has been that incremental ROC or incremental profitability and cash flows are far more important. And companies with some amount of moat, whether it is brand, distribution, whatever, tend to have a better possibility of superior performance over a long term. And companies which are gaining market share mostly tend to do well. I mean, so they're growing faster than the industry, they tend to do well. And this is my classic approach where, I mean, private banks have been in that space, company growing faster than the industry, the banking industry, and the banking industry itself growing faster than the economy, the nominal GDP. So that's been a good space to be in. So that's where, I mean, that is one of the approach that I look at. And in value investing, the clear idea is, like I said, even if it is low growth, as long as the dividend yield compensates for that low growth, I would be happy with that. And being GARP, I mean, if even it is a very good company, I would want to kind of reduce exposure if it goes into the expensive zone. And similarly, as it goes into value zone, would want to kind of increase exposure. This is just, I mean, my predecessor who followed this style for 20 years, the fund outperformed every time the markets corrected more than 20% or the benchmark corrected more than 20%. So style purity clearly helps. And these are some examples. In the interest of time, I'll skip, but just a point that you can invest in all, but all of them take time to play out. And finally, why it is important for you as distributors is you need to understand what you're investing into, what you're investing your investors' money into, whether their risk appetite and the fund manager's risk appetite match, and whether the fund manager is sticking to the style that they are committing, or they are drifting. There is a style drift depending upon what is the market flavor. Because the fund manager may not be wired for a particular style of investing, but just because market is moving that way, if he starts to try to play that way, it will be a big disappointment in the outcome. And same way, it is important for the distributor to ask the fund manager in this style, what is the time or what is the scenario in which the fund manager will underperform? Because all fund managers can go through underperformance. It is better to be clear as to at what time or in what time frame, what style will the fund manager underperform. So it's better to be clear about that as well. And finally, I mean, Prasanna sir did talk about AI. So a lot of you can use AI, or you can use even the rule base that, I mean, value has been doing very well for so long at this point. Now I would believe that next few years, I would expect growth to do well. And to that extent, I would want to move. So that dynamic allocation at the distributor level or investor level, you could consider. So finally, I would leave you with this quote. I mean, there are bulls in the markets, there are bears in the market. Bulls make money, bears make money. But if you're a pig who is looking at short-term opportunity, trying to run from here to there to capture that short-term opportunity, you get butchered. So with that, I'll stop. Thanks a lot for the opportunity.
Thank you, Mr. Karthikraj.